Hi, this is Dee Dee with Money Mastery with Dee Dee, Innovative Financial, and today we are talking about divorce and specifically taxes as they relate to divorced people. It could be related to newly divorced folks, or maybe some of these things are items you haven't thought about and you've been divorced for a while. In any case, divorces are many, many moving parts, and worrying about the tax implications might not be top of mind. So I just want to give you about 7 items to consider as you prepare to finalize your divorce or as you're filing taxes for the first year after your divorce. First thing you need to know is, what is your marital status and how does that affect your filing status? It's critical to know when the divorce is finalized. What I mean by that is, as of December 31, if you're still married, you're married in the eyes of the IRS, and your taxes need to be filed as if you're married. Now, that can be jointly, which usually saves you a bit of money, can be filing separate. If you've lived apart from your spouse for more than 6 months and you have custody of the kiddos, you may be eligible to file for head of household status, which is more favorable financially than just straight up single. So good things to know. When was the divorce finalized? The next thing, and this can be confusing, I'm going to use the word alimony, although some states call it maintenance. It's money going from one of the exes to the other. Divorces that were finalized prior to the end of 2018, any maintenance paid or alimony paid one direction or the other had tax consequences. The person paying could deduct it off of their taxes. The person receiving those monies had to pay income tax on it. So, but if your divorce was finalized January 1, 2019 or later, then there's no taxation. There's no deduction for the person paying it and no taxes due for the person receiving it. So somebody decided that was a good idea. I'm not sure it's great policy, but that's how it is. So it's critical that the amount of alimony you're paying is clearly spelled out in your agreement if it's prior to 2019, so that you know which part has tax implications for you. Next, let's talk about children. There's credits for kids out there, and if you're a parent, you know children are expensive little creatures to keep around. We love them, but they're expensive, and the tax law tries to support parents in their goal of being good parents and raising good citizens. So to do that, one of the tools we have to hand is a child tax credit. And the general rule, only the custodial parent, the one the kids live with most of the year, can claim the child tax credit or credit for other dependents who qualify. And it's worth $2,000 per child, and up to $1,400 of that is refundable. And if it's another dependent, not a child, it's as high as $500 per person. And what I mean by there, those are the kids that are over 16 years of age through college. But it is perfectly legal for the non-custodial parent to claim one of these credits for a son or daughter if the other parent signs a waiver agreeing not to claim the exemption. This is a Form 8332 that needs to be signed. And if that happens, that means the custodial parent can't get that credit for that year. And that might be an important part of your divorce decree, that you agree to share those credits year to year. Related to the kids, and next item is medical expenses for the children. If you continue to pay for a child's medical bills after the divorce, you can include those costs as part of your medical expense deduction, even if your ex-spouse has custody of the child. And for going forward, their deductible medical expenses are deductible to the extent that they exceed 7.5% of your adjusted gross income. But having the children's medical expenses available for you to deduct might push you over that threshold and make those expenses deductible. Something definitely to look at. So at the point of divorce, we often see asset transfers happen. That's, an integral part of a divorce is divvying up the things that were owned inside the marriage. And a divorce settlement will shift the property from one spouse to another. And the shift is a non-taxable transfer, which is really, really good. We wouldn't want the tax to happen. But remember that because it's not taxed, the basis follows along. Thus, if you get property from your ex in the divorce and later sell it, you're going to pay capital gains on all the appreciation before transfer as well as after the transfer. That's why when you're splitting up property, it's absolutely critical to consider the basis in it. As an example, $100,000 sitting in a cash account is actually worth more than an investment account that has $100,000 worth of stock but has a basis of maybe $500,000 because you're going to pay tax on it, so it's worth less. Same thing goes with retirement accounts, because remember, those are going to be taxed too. So when divvying up those assets, keep in mind what the basis is and try and look at assets through an after-tax lens to keep things equal. It's more fair for everyone. Now, speaking of assets, the biggest asset part in most divorces is the family home. If you decide to sell your home, timing the sale is going to be critical. You may or may not know each person has a home exclusion on taxes of $250,000 for a primary residence that they've lived in for 2 of the last 5 years. So if you sell the home fairly quickly after the divorce, between you and your ex, there's a $500,000 exclusion available to you. For sales after the divorce, if the 2-year ownership and use tests are met, you and your ex can each exclude the $250,000 on your individual returns if you still own it jointly. If the 2-year tests haven't been met, sales after a divorce may still qualify for a reduced exclusion. You're going to look at the period of time that was lived in the house. If you wait till after 2 years of the divorce, then you're stuck as a single person with the $250,000 exclusion. So real critical to look at the house and decide how you're going to manage the sale and or the gains on that in everybody's best interest. So there is one thing here that's kind of interesting, and that is IRA contributions. Normally, you have to have earned income to contribute to an IRA, but there is an exception for some divorced people. If you'll recall, I started out talking about taxable alimony and non-taxable alimony based on the final date of your filing, whether it's before 2019 or up through the end of 2018. For folks who were divorced earlier, up through the end of 2018, if they're receiving taxable alimony, they are eligible to contribute to an IRA as if those funds were earned. So that means in 2021, you can contribute up to $6,000 to a traditional IRA or a Roth IRA or some combination of the two. And if you're over 50, you can even contribute an additional $1,000 as in the form of a catch-up contribution. So those are some tax benefits and tax strategies or ideas around divorce that if divorce is new to you, you need to know about. If you've got questions on this topic or really anything financially related, we're here to help you. Reach out to Dee Jones, Innovative Financial. Call us, message us. We're here to answer your financial questions.